How's it going, everyone? Max here, Wealthier by the Day. Day 11. I got 3 topics I'm going to cover similar to the other videos. I'm not a financial professional. Please like, comment, and subscribe. Okay, let's get into it. The first topic I'm talking about is how I'm going to invest $400. I like to invest $500 a week. This week I am settling for $400 due to budget constraints. So I'm going to tell you 3 stocks I'm going to invest in, and then one index fund I will be putting some money into. If you've watched any of the other videos, it's probably not going to be much of a surprise, but that's just what I'm going to be doing. The next topic we're going to cover is growth stocks versus value stocks, what you should be investing into if you do want to invest in individual stocks, which I do not necessarily recommend everyone invest in individual stocks. This isn't, none of this is a recommendation at all. Just FYI, disclaimer. But if you are going to invest in individual stocks, well, what should you be looking for? Because you'll see a lot of people say growth, a lot of people say value. What is right? What is the reason one person would do one thing and another person would do another thing, right? So we're going to look into that. And then the last thing we're going to cover, which will probably be interesting for you, is 3 monthly paying dividend stocks that can help you generate passive income on a monthly basis without having to invest in a number of different quarterly paying companies and basically trying to invest in enough quarterly paying companies that you're actually earning monthly dividends, if that makes sense. I have a ton of different Instagram posts on that. So let's get into it. Okay, how I'm going to invest $400 this coming Friday, which is in a couple days. I'm going to invest in 3 stocks. The first one is ticker symbol PARA. That's Paramount Global, U.S. company, media company. You probably know them from the entertainment industry. Very popular, very popular, proven brand name. That company currently has a 1.6% dividend yield. The real kicker, and this is what is appealing to me, is it has a 0.37 book price to book ratio, which is great. That means that the company has much more assets. Basically, it means its book value is more valuable than its current market capitalization, which suggests the company is probably undervalued and that the share price is going to go up in value. And essentially, like a PB ratio of 1 would mean your book value, your book market capitalization would equal your, like your stock market capitalization, if that makes sense. Basically, your book value is equal to the price that the stock is trading. So ideally, you want to look for companies that have very low price to book ratios, below 1 ideally, because that means that there's some value there. And something like Paramount with a 0.37 price to book ratio, chances are there's a reason it's trading that low, but I I think it is a worthy stock to buy. Currently, there's some unprofitability built in, but again, with a price to book ratio that low, that means that the company could go and liquidate all of its assets, and you would end up getting a payout more greater than your share price, if that makes sense. So to me, it is worth the risk, and value stocks in nature are inherently risky. But to me, a 0.37 price to book ratio is worth the risk for a company that reputable or that popular as Paramount. And I mean, not to mention, I always use this as a good gut check, but Warren Buffett bought a ton of Paramount stock. And I'm not saying just do whatever Warren Buffett does, but if you're thinking that it's a good idea and then you see Warren Buffett do it, I don't know. To me, that maybe it's confirmation bias, but to me, that's a pretty easy way of telling me, yeah, this ain't a bad idea. Why don't you buy it? So again, I'm only putting like $100 into it, so it's not a huge risk. It's a lot of money for me, but anyway, so Paramount's the first one. Next one is Jackson Financial, ticker symbol JXN. Similar situation, has a 6% dividend yield and also has a 0.37 price to book ratio. Recently, their profitability has been questionable, although they have a ton, like they have super high cash flow relative to their share price. Like their it would be cash flow per share relative to the share price, which would be similar to like earnings per share. Is I don't have the figures on me, but I mean, we're talking like $15 per share in cash flow, and the stock is trading at like $35, which to me, that means um, I'm getting my money back very fast because the company is generating a ton of cash flow per share. So that stock again is super undervalued, and I'm already up like 20 or 30% on it. I just don't see. Again, I think it's a home run. Like I don't see where I'm going to lose on that one. That's what you want to look for. I mean, stuff that's super. It's like it's chances are it's going to do well, and if it doesn't do super well, it's probably at least going to go up a little bit, and I'm not going to lose money on it. So that's kind of what I'm looking for. So yeah, that next one was ticker symbol JXN, and of course, just do more research on this. All of this is off the cuff, so I'm not going to bring a ton of information to present. I'm putting the ideas out there. It's up to you to do your real research. I mean, I'm telling you the things that are important to me. But it's up to you to confirm whether this is a good or bad idea. Again, this isn't a recommendation. This is just me talking about what I'm going to do. The next one is Citigroup, ticker symbol C. Again, I've talked about this one in past videos. A price to book ratio of 0.41, which again is super cheap for a huge reputable banking company. In a dividend yield of 5.15, I just, again, don't see where I'm going wrong on this one. Warren Buffett's buying this one up like candy. I tell you what, he'd probably be buying Jackson Financial if he could, but they trade at such a low market cap. I don't even think Berkshire Hathaway is allowed to buy them because their market cap is so low. That's something that I learned relatively recently that I had no idea, that like Berkshire can't buy companies that are less than a certain market cap value, which is why they have to deal in such huge companies now. Anyways, so Citigroup's that other one. That's one of like the four biggest domestic banks in the U.S. Like you have U.S. Bank, you have Bank of America. Well, I guess you have Chase and Wells Fargo, and then you have Citi. So I guess five. But those are like the top five big banks that I can recall, like off the top of my head, which to me, that's a good sign. And I don't know. Banking never seems to go away, and it's usually a pretty profitable venture. And usually the companies involved are bringing a lot of value. So I like Citigroup. All three of these, again, I'm going to invest $100 into each of them. And that may not seem like a lot of money, and it's not. But it's like if you consistently do this over time, and with these stocks, my hope is that I get above average returns. Hopefully I'm like beating the market or getting double the market return. Well, you do enough of that over time, and it's gonna move the needle eventually. Maybe not in the short term, right? But over the years, it'll move the needle. So I like those three individual stocks, and then I'm gonna put $100 into FXAIX, which is Fidelity's S&P 500 index fund, just for good measure. Put 25% in index funds, and it really fluctuates for me. Sometimes I'm real gung ho on investing in individual stocks that are really cheap in value, because when I invest in individual stocks now, it's always value stocks. It's never growth stocks, which we'll talk about next. But when I invest in individual stocks, I look for companies that are bringing a ton of value and are also profitable or should be profitable in the future, that have solid, price to earnings, that have solid earnings to price. Also, that's another thing. It's the reverse of the PE ratio, is the E to P ratio, which I kind of like. It's just another perspective on it. And companies that are actually producing cash and pay a dividend and seemingly have pretty consistent cash flow, or their cash flow is increasing over time. So all of these things kind of inform my decision on whether I want to buy a stock or not. But like these three companies I just listed, the value itself is to me, that's the big, that's what I have my eye on. And I'm just like, I find it, I just don't see myself losing on these ones. Maybe I'm not going to make a ton of money, but I don't think I'm going to lose, which is the most important part. Rule number one is never lose money. And rule number two is never forget rule number one. That's what fucking Warren Buffett said, baby. So it's true. So those are the three stocks, and then the one index fund I'm going to invest that $400 in. Nothing crazy, just little progress over time. That's all investing really is just making a little progress over time. So, okay, that took long enough. Let's go into the next point. Growth versus value. I kind of just touched on this, but if you're investing in individual stocks, I'm telling you, especially if you're new, even if you're, I guess, kind of know what you're doing also. Like, value stocks are the way to go. There's this phenomenon, I guess you could call it, that exists in the stock market or markets called the value premium, which pretty much states that value stocks are companies that trade um, at a good value. And I mean, a good value would be a price to book ratio of one, or really a price to book ratio under one. But companies that trade at a good value are typically more risky, which inherently you would think growth stocks are more risky, but inherently value stocks are more risky because of profitability. Um, like growth stocks, for example, not all of them, but you look at the Googles and the Facebooks and the Amazons, they usually have robust profitability built in, which is part of the reason that they perform so well. They don't trade at good values, but they're incredibly profitable companies um, that typically have a good return on assets or return on capital, which is what informs some of their great returns, at least in the past, maybe not so much in the future. But value stocks do not inherit, like, that profitability is questionable. And a lot of the time, a value stock is going to be a company in a declining market, or it's a company that is not performing too well from a business standpoint or a production standpoint. And that's where that risk is built in. So there's high risk, high reward built into value stocks. Um, and historically, the value premium suggests that value stocks actually outperform growth stocks. Although in the last 10, maybe 15 years, that trend is has been scrutinized and is questionable because growth stocks have performed so incredibly well. But based on historical data, value stocks have actually beat growth stocks in terms of total return on investment, which a lot of people might, especially people that started investing in the last 10 or 15 years, might not believe, because growth stocks have been on such a incredible run with the with big tech and all that, right? Like all those big growth stocks, like the FANG stocks, like I just mentioned. But with that said, value stocks do inherently pose more risk, but like I said, they also inherently pose greater reward, because higher risk typically equals higher return. Like, basically, if you are willing to take the risk, you will get a higher return out of it potentially if things work out, which is why I focus on value stocks. Not to mention, there's like Warren Buffett, obviously, is known for investing in value stocks, and it has worked incredibly well for him, and he sticks to pretty simple criteria. And it is hard making money investing in individual stocks, and you're going to lose sometimes, but um, there has been winners. And I'm not saying to invest everything in a super risky value stock, but maybe put a little bit of your money in there. Make an informed decision. Yeah, like you're not Warren Buffett. You're only going to know so much. But if it's smaller amounts of capital, it's like, whatever, it is what it is, right? It's kind of fun playing sometimes, with the, it keeps you engaged. Like, to me, it's like, if you're on a diet, like a good diet is like 90% healthy foods, wholesome foods, and 10% is junk food. Like, 90-10 is pretty good. If you're investing 90% of your money into index funds or ETFs and the other 10% into individual stocks or more risky assets, at the end of the day, if that's kind of your allocation, then so be it. I mean, it keeps things interesting, and who knows, maybe you'll win with the individual stocks. That's kind of my thinking. But anyways, that's a little beyond the point of growth versus value. But bottom line, the reason I would pick value over growth is, historically speaking, value stocks tend to perform better than growth stocks. And growth stocks, you are paying a premium for earnings in the future that you do not know are actually going to happen. Like, you are basically trying to predict the future. Like, you're predicting that a company is going to be more profitable than they currently are, which, like, that you're predicting that their earnings are going to go up because you're buying companies with a high price to earnings ratio typically, which means that, like, the share price relative to the earnings per share is really, basically, you're not getting a whole lot. Like, you're overpaying for the company at the end of the day. And when you're overpaying for a growth stock, what you're saying is, well, I'm willing to pay a little bit extra now because I believe they really will perform that much better in the future. And like my bullish thesis will come true, and this company is going to deliver even greater returns in the future. So the share price will go up, and I'll be rewarded as the share price increases, and maybe they'll start paying a dividend. But that generally actually doesn't happen. You're better off investing in more established businesses that have, like that you can track historically, and businesses that aren't trading at outrageous valuations. You want to invest in businesses that are trading at either good valuations or really cheap valuations, like a good business at a fair price, or a great business, or sorry, a great business at a fair price, or a good business at an incredibly cheap price. That's kind of what you're looking for. You have to think about investing as like, when you're buying shares of a stock, you're investing into a business. So when you buy one share of, like, let's say Coke, pretend that you just bought the whole business. Like, what if you bought a business, what would you want that business to do for you? Well, if you bought a business for $100, you would hope to get your initial investment of $100 back within, I don't know, 5 years, right? Maybe that's a little soon. Maybe 10 years. Like you get your $100 back in 10 years, and then after 10 years, your net profit, like you're all profit, right? That's how you have to think about shares of a stock. It's like, if I buy Coke at $100, like what's Coke earning? Like, okay, their earnings per share are $10 a year. Well, that means it'd take 10 years for you to get your investment back. If you bought it for $100 and they're bringing in $10 every year, will it take 10 years for you to get your investment back, if that makes sense. So you want to buy companies that have low share prices that are bringing in huge earnings per share, because that means relative to the share price, they're bringing in a ton of money. And you have to think of it that way. You're going to get that money back either through capital appreciation, or they're going to pay you a dividend. They're going to literally pay you that money in the cash in the form of a dividend. So anyways, just stuff to think about. I know that kind of got off the point a little bit, but a lot of good stuff to think about and try to understand, because when you buy a stock, pretend you're buying the whole business. That's another Warren Buffett thing. But once I started thinking that way, it changes your perception on things. Like, you wouldn't buy a company that is trading for $100 and every year they're only generating $1 in profit, right? It'd take you 100 years to get your money back. Like, why would you? And that's a lot of those big tech companies. And you might say, well, no, I think next year they're going to earn $5, and then they're going to earn 10, then 20. It's exponentially going to increase, which you can think that, but it's just not a super safe way of investing. You're better off going with tried and true companies that are trading at reasonable values, with some predictability of, okay, they're going to return X amount each year, and I'm going to make my money back in hopefully X amount of years, if that makes sense. So anyways, we'll move on to the next one. I hope you guys stuck around for this one, because I think this one's interesting. 3 monthly dividend paying stocks. I'm going to list all three. I'm going to list the dividend yield, and I'm going to give a general idea of if it's trading at a good value, if it's, how profitable they are, all that. So the first one is the favorite of everyone for monthly dividend paying companies. That is Realty Income, ticker symbol O, known as the monthly dividend paying company or stock. They currently have a dividend yield of 6.03%. They've been trading relatively cheap lately compared to the past few years. From what I've seen, I keep an eye on this one. I actually don't own any Realty Income stock myself outright. I mean, I own it through ETFs, but I don't own individual shares of Realty Income, just because it has always traded at a little bit of a high value, and I've never cared to invest in it because I never thought the value was great. But it's currently trading a valuation. Seeking Alpha kind of gives grades, so I just pulled this information just to give you guys a general idea. But the valuation on Seeking Alpha is a C+, which I would agree with that just based on some of the metrics I saw. So not a terrible, it's not super, it's probably a little overvalued still. Not like a relatively fair value, I suppose, but nothing special. This company is incredibly profitable, though. I give it an A+ for profitability. So that should tell you something. If this company if the share price continued to drop to the point where it seemed at a bit of a more of a fair value, than it's trading at now, I would consider buying it purely based off the profitability, and that's a huge dividend yield with the monthly payment. I mean, that's pretty awesome. So something to look into, and maybe if you're not planning on buying it, at least add it to your watch list, because it's a very reputable dividend paying company, and for good reason. They're incredibly profitable. The next company we got is Main Street Capital, ticker symbol MAIN. This is one I remember from like 5 or 6 years back when I first started really getting interested in the stock market. One of the first companies I probably ever bought, actually. I don't think I own it anymore, but when you first start investing, at least I did, when you start investing in individual stocks, you just go like, it would keep me up at night. I'd have like nightmares about, oh, did I pick the right stock? And now I'm just like, it doesn't matter. Who cares? But anyways, Main Street Capital, another monthly dividend payer. This one is trading at a bit of a better valuation. Looks like more of a B minus with, again, awesome profitability and A plus. So this one could be a good buy right now. Check it out. I like it. And it's got a dividend yield of 7.02%. And caveat, all of these companies are unqualified dividends, so you end up paying a little bit more in taxes, just FYI. It's part of like Main Street Capital. It might be a financial REIT, actually. I mean, I know the other ones are REIT, real estate investment trusts. Main Street Capital might be a financial REIT, though. So just FYI, like the dividend payments are pretty high, but you will pay extra taxes on that. Now, if you can find a way to not pay taxes on passive income, maybe if you own real estate and you have you're a real estate professional, you can basically take real estate deductions and deduct some of those expenses from other passive income. That could be a great way using these unqualified dividends. That's just a huge like nuance right there, which I've thought of in the past that I'd throw out there. But yeah, you will pay more in dividends. Anyways, Main Street Capital, that's the second one. Third one is Apple Hospitality REIT, which is ticker symbol APLE. People might get this mixed up with Apple, the tech company, but it is Apple Hospitality REIT. This one's trading at a 5.92% dividend yield with a valuation of a B plus. I've actually looked at this one in the past. I was very close to investing in it. I just didn't end up doing it, and a profitability of a C minus. So probably not a bad one to look into. I'd say Main Street Capital and this one are probably better looks right now than Realty Income. But do your research, check it out. You know, these aren't suggestions. Just do your homework and make an informed decision. I did want to throw a bonus in, though, and that is the ETF, the JP Morgan Premium Income ETF, ticker symbol JEPI, which is a newer ETF that people absolutely love, especially on my Instagram page. I mean, people can't get enough of that one. It's right now it's got a 9.68 dividend yield, which is why people love it, because it's like it just pays a huge fat dividend. The one caveat, and I actually don't know if this is a qualified dividend or a non-qualified dividend, so you're going to have to verify that information yourself. The one caveat is it does have a 0.35% expense ratio, which to me is incredibly high. That means, for example, if you invested $100 in the market, you would pay, for every $100 you have invested in the market, you'd pay 35 cents to JP Morgan just for buying that $100 of their stock and holding it, which, again, may seem like a minuscule amount of money to some people. To me, I don't like it. That's a little too much for me. At that point, I would rather just, oh, sorry, this is super shaky. My apologies. I would rather just invest in the S&P 500 and pay literally like no expense ratio. That's just me, though. Like, at the end of the day, apples to apples. I mean, if you really, again, if you're trying to leverage like dividend income, then maybe that's one thing. But total return on investment is capital appreciation plus dividend. So my gut tells me if JEPI is giving you a 9.68% dividend yield, then this stock, this ETF is probably not going to experience much capital appreciation. If anything, its share price is probably going to be affected negatively over time, which total return is let's say it pays a 9.68% dividend. but the share price goes down 9.68%, you literally have a net zero return. That's what a lot of people do not understand. It's like the dividend completely influences capital appreciation. Like on the ex-dividend date, the shares of a stock will drop by whatever the annual payout amount is for that stock. Um, I don't think a lot of people understand that. I believe it's the annual payout, or maybe it's the quarterly payout. That would make more sense because it would drop proportionally to whatever payout you're getting. But bottom line is, it's like the dividend is not free. If you follow, like the dividend is part of your total return on that investment. So like if a company is paying you, like if company A is paying you a 5% dividend and company B is paying you a 0% dividend, and company A goes up or goes down in value, or sorry, increases in value 5%, it would essentially be, if this makes sense, like wiped out by that 5% dividend. You would net zero. And then company B, if it went up 5%, you'd get 5%. So you'd be even Steven. And I'm not, when the company pays a dividend, its share price drops proportionally to that amount of money they're paying in the dividend to basically make it so you're not getting that free lunch. So that's something to look into yourself. Like I might be explaining it poorly, but that's something a lot of people don't realize about dividends. The more you learn about dividends, the more you realize it's not the free lunch everyone thinks it is. It's awesome, and I recommend if you're going to invest in individual stocks or ETFs especially, you should be getting a dividend payment because you want that asset to be actually producing cash. What you do with that cash is up to you. I mean, I reinvest it back into the market, different spots depending on what I'm doing at the time, but or you could take that cash and actually use it for expenses. So anyways, okay, this was long-winded. I'm going to cut it off here. Um, I'm not even going to recap. I usually recap, but I think this is long enough. So thank you everyone for watching the video. I hope it was informative. Please subscribe. Please like. Please leave me comments on any other topics you would like to hear about. Like I'm all about it. I'm here to help. I hope this information is useful. I have fun making these videos, so that's the main reason I do it. But I hope it's, if it helps you guys, that's even better. That's what it's all about. So right on, guys. Max signing off. Wealthier by the day. Day 11. Catch you later.